On today's show, 3 questions. Number 1, ni hao ma. Number 2, is the AI bubble about to pop? And number 3, what the heck is a Trump account? Let's go.
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Will.
And I'm Rabih.
Yeah, you are. And Rabih, you got me today. You got me, and I went for it. For those of you that don't know, we on this show, each one of us brings a question, and I mean, that's kind of the topic. We announced them at the beginning, and I look at the doc this morning, and Rabih was making me speak Chinese, and I was like, you know what? Let's go for it. So, ni hao ma. Apparently, it means what's up.
Yeah. How's it going?
Okay.
All good.
Okay, Rabih, ni hao ma. What's happening to Chinese stocks?
What's happening to Chinese stocks? By the way, next week you're going to speak in Arabic, just saying.
Yeah. We're just going to start adding different languages for me. I love this.
So with the US government closed, it doesn't affect us as investors, but it affects us as podcaster. Like, I could not get data. So I thought, let's talk about the Chinese economy today.
Love it.
Here's the hook for you guys. What do you think is the performance of Chinese stocks year to date? Without cheating.
No, literally no idea. Strong to quite strong.
I mean, Emerging's had a good year, right?
Emerging's had a good year. I think Emerging's up 26 or 27% as a...
So I assume China's part of that.
It's got to be a big part. I bet it's pushing 30.
Okay, so year to date, US is up 15%, all of US. A globally diversified portfolio is up 19.9, almost 20%. And Chinese stocks are up 41.5%.
Ooh, okay.
Huge number.
Huge number.
Yeah.
And I wanted to get into the story. I wanted to see what has happened that changed it. But the caveat here is that even with this 41% rebound, it's still not breaking its all-time high from 3.5 years ago. And we're going to get to them in a second. Let me give you a quick refresher on what the path the Chinese economy has been taking and how the stock market has reacted alongside with it. I think the divergence between US and Chinese economy happened with how we reacted to COVID. China had a complete lockdown where we decided to keep the economy slightly open. With that, China was able to have a quicker rebound for a certain period of time until that complete lockdown was too detrimental for growth, choked the economy, put it into a recession. Back in 2020, the economies did well. Chinese economy did better. China was up 28% in 2020 as a stock market. But then in 2021, 2022, and then 2023, we had negative years, negative 19.6%, negative 22%, and negative 9.8%. It's quite rare to have 3 negative years without it being a severe recession. So here's what happened back to back between the years that has caused it. We got the China reopened early after a very strong crackdown, and that shook the economy. And then in 2021, there was more of a regulatory attack against tech companies and IPO companies, and that crashed the whole tech sector in China, including like a lot of Chinese tech figures that are not going up on the media anymore. It was slightly controversial. That took away some confidence in the Chinese stock market. In 2022, there was starting to form slowdown in the real estate market. I don't know if you guys remember when we were talking about like Evergrande and the whole real estate
the real estate
for
stuff.
China taking a hit. So it didn't happen until like liquidation didn't happen until 2024 for Evergrande. But like from 2022 to 2024, you got the stocks bottoming, real estate confidence, like real estate problems, confidence of the economy going down. 2023, the recovery was underwhelming. They tried to do a recovery, but inflation undershot. The economy could not get moving. They went into a recession and they weren't able to get it up. And then in 2024, remember, they came up with this package trying to stimulate the economy. They lowered interest rates a little bit, but Chinese people were still buying gold instead of buying stocks, and there was no confidence. So in 2025, there has been drastic changes to policy, and this is what we're going to talk about today. That is rallying the equity markets, and with that, probably shifting stuff and putting them on the right track. So here are the policies that happened in 2025, and most of them are as new as September, like last month. And those all fall into the realm of why the Chinese stock market has been rebounding. So there has been an action plan on 3 fronts. The first front is consumption support. The second front is market financing versus plumbing. And the third one is credit/investment push. And you guys will find it, I don't know, when I was reading it, I found it very interesting how different economic policy can be from one country to another. Like, this is not a policy you would ever see in the US. So let's get into them. The first one is consumption support. So the government is giving people the option to trade in to get subsidies for their trade in. So if you, for example, go and buy an old fridge, the government will give you like sell your old fridge and buy a new fridge. Although your fridge is still functioning, the government will give you a 15 to 20% rebate. They are trying to push people to like replace old appliances, boost factory orders, support consumer confidence.
And you don't need to do that in America because
you don't
just buy it anyways.
Yeah.
So yeah, it mainly on cars, like transportation and appliances. There's been a push of rebates across the board, trying to get the economy to start moving, start shuffling. The second one is interest subsidized consumer loans. So for loans under 50,000 yuan, which is around $7,000, to buy like computer appliances, home renovations, etc., the government will cut out 1% out of the interest rate you pay for a bank. So if the bank is charging you 5% for the small loan, you're going to only pay 4%. The government is going in to subsidize your loan. That is at the consumption level, which is not as crazy as the next one. The next one is related to market pumping. And like, this would be absurd in the US market. But there have been mainly 4 fronts where they are trying to make the stock market more appealing, increase the confidence. And the wildest of them all is that they created a state investment arm called Huijin ETF buying. And what it does, it steps in as a national team and buys stock market ETFs. And it's exactly like the government putting in a big buy order to stop a sell-off. So imagine this, I don't know, S&P 500 is going down and, the government decides, you know what, we're going to open a brokerage account and we're going to dump in trillions to keep the price up. This explains why 41 does not seem as absurd anymore, because
holy
government
cow,
has went into the...
Yeah, artificial, can we say?
It is artificial.
And they're specifically buying Chinese stocks. Like, they're not buying a globally diversified portfolio. It's just only Chinese stocks.
Yeah, it's an attack against speculators in the market. But is it really speculators? The market is an efficient machine that processes information. So if it's going bad, the machine should reflect the lower prices. So yeah, this is the big one. And let me bring up the data on the flows. So by the end of June 2025, the state national team, Central Huijin, held around 3.94 trillion yuans in yuan-dominated stocks, ETFs, surpassing foreign investor holding of 3.07 trillion. So you've got almost 0.9 trillion, 0.8 trillion over what all the rest of the world is investing in China. The Chinese government is investing in its own stock market by almost $1 trillion over. And they have made gains because the stock market is up themselves, but this is still not really impacting how the market is functioning. There are still flows out, especially to Chinese ETFs. So inflows to China equity ETFs dropped sharply. In mid-2025, inflows to these ETFs were down 74% year over year, 119 billion yuans, as investors are taking profit. So it's actually forcing the government to double down. They think the stock market is down. There's not enough confidence. We said, hey, you know what? We're going to go in, do a big buy order, elevate all these prices. And people, what ended up doing is that they started taking out profit, dropping the price even more. So they have to double down and buy even more.
Oh my gosh.
This is what is going on. So this is related to the stock market, but there are 3 other ones related to the markets. They've got state-owned enterprises. So it's like big government-linked companies. So like imagine the equivalent of it here would be a gold miner where the US government owns like 50 to 60% out of it, that type of thing. Or if Apple was 40% owned by the US government. They are absurd to Americans in that sense, but this is very common over here. So those state-owned enterprises are encouraged to buy back their own stock or promise not to sell to show confidence and support in prices. You know, a stock buyback is equivalent to a dividend, but it doesn't pay taxes. You don't have to pay taxes on it. So they're trying to push to increase dividends. Tighter rules on programs trading and trying to curb big sellers. So authorities are clamping down on high-frequency traders and large institutions dumping shares quickly. This is like telling big players, you can't crash the market with sudden heavy selling. We are here. We are still going to be buying, and we're going to go after you legally if you try to crash the market. And the last one, and I think this is the only one that probably affects an American investor investing in a globally diversified portfolio, is that previously overseas funds investing in China had been limited in what it can buy and do, and there weren't really tools for hedging. Now they can use stock options, which can prevent a slowdown. So in the future, if we in the past, when we wanted to buy Chinese stocks, you either have to go and buy an investment company in China that does investing there, an American company that does investment in China, or you do something called American depository receipts, which is you go in it with a deal with a bank, and that bank gives you a receipt, which is more of a contract, which price mimics the price of a Chinese stock. So that way, you're able to get into the country legally to do the investment while you are from the US. And that worked because you can have stock options or options on the American depository receipt. You can hedge the depository receipt, but you couldn't go all the way in. And they're called shares class A in China. You can't go to and hedge that class A shares in China directly. Now they are expanding the amount of shares that probably have options on them. So you could hedge them, you could control upfront the risk, which for the future is a really good sign, unlike the previous three that actually distort market efficiency.
Those Class A shares, Rabih, in China are reserved for Chinese citizens, government, and companies in China, right?
Yes.
Okay.
And the reason there are different share classes is because like politics is involved. This it's similar to preferred shares versus common shares or Class A versus Class B in the US, where some of them have voting power where the others don't. And this is why those exist, because they would want to consolidate power, but not eliminate people from investing. The third one, and which is the most logical one that, wouldn't be a surprise, is a credit versus investment push. So what's been happening is that in September 2025, last month, Beijing gave policy banks, so they are state-owned banks, they're called policy banks, a big pot of money, around $70 billion US dollars, to put into infrastructure or priority projects. The goal is to refill capital pools for new roads, green energy plants, or affordable housing. It's a way to get investment going without directly opening the floodgates of consumer stimulus. Really just increasing credit in the economy, which is, from the American perspective, the most, known way to stimulate the economy. But here we are. And this is why Chinese stocks are up 41% this year.
By the way, I noticed that you asked that question. I had the doc right in front of me and had the answer right there. Mm-hmm. It was literally an open book test. Mm-hmm. And I didn't notice it. I wasn't even looking at the graph. I was like, I genuinely didn't know. And I looked over after you started going and I was like, oh, it's right there. So win for the attention to detail there. Rabih, I have a question on that. So what I was hearing you say is like some government level market manipulation on the equity market, that with this group that they have just like putting in massive buys. How do we differentiate that from what happens in the US in like the fixed income market when it comes to like the open market committee, like Fed, quantitative easing, basically? Like what's the difference between what we're seeing in China on the equity market and what we've seen in recent history in the US with quantitative easing and the central bank getting involved in purchasing of like fixed income in the capital markets?
That is a really good question. And, the more the government gets involved in markets, the more the line is blurred. But I think there's still a big difference between equity markets and fixed income markets, because the US is not the only country that goes and intervenes with its fixed income markets. Like
Not even close.
Japan controls the whole yield curve, not only the short-term rates, right? The US controls the short-term and tries to influence the long-term by quantitative easing versus tightening. But I think the difference is who is doing it. Is it the government or the central bank? In the US, the central bank is a complete independent, all of this between quotations, special
yeah, we hope that continues to be the case. Yeah,
that is the case. But constitutionally, it's an independent legal entity, the central bank. And the central bank's role is a lender of last resort for banks, right? So when they are going there and they are influencing the fixed income markets, they are just doing their operations. We lend and we decide when we want to lend. And the way we do it is like there isn't really a button in the Federal Reserve room where they say, oh, we're going to click on 4%, turn it off, and then click on 3%, turn it off. This does not work. It doesn't work that way. The way they decide, oh, we're moving it from 4% to 3%, it means we're going to start buying more bonds than we usually do to drop interest rates down. So everyone is forced to trade at the 3%. So they have to interact with the market to get that price down. In terms of China, I think it is not the central bank that is trying to do its job regarding monetary policy, how the money flows into the economy.
It's the actual government.
It's the actual government, and it's a matter of control rather than like they are trying to control a situation rather than to monitor or tweak a system for it to grow on its own. Like if the government decides to pull out of these huge on ETF or all these market, quote unquote, manipulation. If you're the government, you're not manipulating. You're just moving them. You are making the market how you like it to be. If we take the government out of it, that Chinese economy is still in a tough spot. GDP for the quarter is around 4.05%. Their target is 5%, unlike us. So it is in line, but consumer confidence is still down. Retail sales are still down, if you want to translate Chinese data back. So if the government pulls out of that thing, the economy can still not grow and flourish on its own. So the fact that the government intervention is a necessary condition for the prices to be as such tells you that this is slightly different, because the central bank in the US can choose not to intervene. For example, if a recession starts happening or some companies start declaring bankruptcy, the Federal Reserve can go in and say, oh, we're not coming in and giving people the Greenspan foot and helping them out to stay afloat. The market will panic, will crash, but it'll correct itself. In China, if the government decides to pull out, there is still doubt that the market can correct itself due to the fact that they have had zero confidence in their equity market for the past couple of years.
Yeah. I'm glad that was a great explanation. And maybe a more apt parallel or analogy would be the 2008 bailouts, bank bailouts. And there was a lot of controversy, and still is, with 2008, 2009 and the bailouts, and some prominent people in politics. Mitt Romney, I remember being one of them, really advocating for not bailing them out and letting the natural market take its course. There's no counterfactual we can prove of what would have happened if they did that. But it's just interesting to think, like, I hear what you're saying about China, and I'm like, man, that's crazy. That's just market manipulation by the government. And then I'm like, is that unique to China, or is that happening
it's really
in the US as well?
Where you, on one end, one extreme, it's like complete, let the market do what it does. And that is actually, by the way, not completely healthy, because if we go back to the early 1900s, that leads to monopolies, that leads to lower productivity, etc. And on the complete other extreme of that scale, you've got complete government control of markets. And we know that is bad.
Yeah.
You know, that is communism at the end of the day.
Yeah.
And you have to find the middle ground. Maybe the US is 1/3 of the way into the scale from the side of complete laissez-faire type of economics, whereas China is probably 1/3 or 1/4 of the way from the side of complete government control.
Yeah.
Is there a proper recipe? Is there like a truth? It's really much more complicated, but because it really depends on the threats that the economy is facing, the new technologies, how it's internally changing. And the role of the government is just to keep the unity and cohesion for the economy to keep growing the way it should. So I don't think there's a right answer, but we are more inclined to like one over the other. And yeah, that's where we would leave it.
Yeah. Will, You want to get you in here?
I just feel like it's I don't know. They're trying. It's working, but it feels like it's a Band-Aid over an infected wound almost. Like maybe you think about like, yeah, they're putting money into the stock market so it doesn't crash, right? But there's a reason that it's dipping. So it's manipulation, and it feels like there's another boot that's got to drop at some point, and we'll see what that is. Or I don't know, does China's government run out of money, or do they stop doing this at some point if the market continues to? I think it's hilarious that individual investors took profit after China pumped the market, and then people sold out and took profit.
Yeah, it's a good point, Will. I feel like anytime you try to artificially remove pain or remove risk from an investment or from a market, it's just leading to a bigger
like kicking the can down the road. Yeah. Like at what point is this a bubble or whatever, right? Like do they thread the needle perfectly and it works great? We'll see. But I mean, we have these conversations a lot when government gets involved, like when the Fed lowers interest rates. They're like, is this going to work, or is this going to blow up in their face?
Yeah. I'm really glad we had this. It flows in really nice to the next topic. But Rabih, any other final words on this? Okay, so keeping an eye on this. Would seem obvious, perhaps, that China's market is a bit artificially inflated right now, but 40-something%. I mean, it's nothing to sneeze at. So, all right, let's jump into the next. Again, this flows really nice because I wanted to talk about AI. And is the AI bubble about to pop? I say that tongue in cheek. We don't know if AI is a bubble, but we've talked about this on and off over the last few months about AI in general. And I've got some numbers here to talk about. So over the last few weeks, a couple of big things have happened that I think is worth addressing. So OpenAI is going to invest $300 billion in Oracle's cloud computing. NVIDIA, pretty much around the same time, committed $100 billion to invest in OpenAI. And then Oracle is spending billions of dollars on NVIDIA's GPUs. So NVIDIA is investing in OpenAI, and then they're investing in Oracle, and then Oracle's investing in NVIDIA. So it's like, it feels like
rock, paper, scissors.
Yeah, it kind of feels like the equivalent of like, let's just all lock arms and go into this fire together. Not claiming it's actually a fire, but like they're all just kind of in this, like they're all intertwined, and we're talking billions and billions and billions of dollars going into this. Ben Carlson, we've mentioned him before. He's great, writes a great blog called The Wealth of Common Sense. So he talks about this exact thing around the .com bubble, and he's making parallels basically to this massive investment happening in AI and what we've seen. I guess first giving reasons to believe this could be a bubble. Like there are some reasons to believe this just based on this parallel. So during the .com bubble of the 90s, telecom companies laid down more than 80 million miles of fiber optic cables. 5 years after the bubble burst, 85% of these fiber optic cables still were unused. So massive, massive investments. There was railway bubbles of the 1800s. Where same thing, massive investments were put into railroads. He says this, there were 500 new railroad companies by 1845. The same year, the Board of Trade was considering some 8,000 miles of new track in Great Britain alone, almost 20 times the length of England. The cost of the build-out was more than national income of the entire country. There were 14 bi-weekly newsletters about the railroad industry in circulation. Charles Darwin got caught up in the bubble, losing 60% of his investment. So the first part of this just saying, to think it's a bubble would not be out of the question or completely irrational based on some historical parallels. One other piece of data I want to highlight before we talk about how this might not be a bubble. So JP Morgan's Michael Sembalist, he wrote in a new research piece, AI-related stocks have accounted for 75% of the S&P 500 returns, 80% of earnings growth, and 90% of capital spending growth since ChatGPT launched in November of 2022. It's pretty wild. Like the level of money, the level of growth of AI feels like in some ways it's propping up the market. And so again, I think there's some natural possible worry of when we hear this idea of like what's coming, if something's coming. It probably is speaking to something around this of just this can't hold. On the other side of this, I'll lay this out and then get your guys' thoughts. If this is a bubble, Ben Carlson calls it the weirdest bubble ever, because we also at the same time have gold at all-time highs. We've already highlighted that in a couple shows. And then also, we mentioned this as well, $7.7 trillion sitting in money market funds. So it's pretty weird. The quote I have to highlight here, where is it? He says, these companies are spending, so to the stat I gave earlier, these companies are spending like drunken sailors, but they can all afford the booze. So it is kind of wild. I want to get your guys' thoughts on this. I've mentioned this before, Rabih. This market feels weird. Doesn't mean bad, but it does feel weird when you see these numbers of how AI is driving the entire stock market, basically, both price growth and earnings. But also we're sitting on like $8 trillion of cash. So that doesn't support it being a bubble. What are your guys' thoughts on this?
I just think I think it's kind of interesting that I love that I think of borrowing money from my friends and then turning around and another friend needs to borrow money and then that friend lends money back to the friend who lended money to me. It just seems like we all have the same amount of money at the end of the day.
Yeah, for sure. Yep.
So I'm sure it's not exactly like that, but it is an interesting phenomenon where, like you hear the news of what Oracle stock did when OpenAI, invested the whatever 300 billion and Oracle stock just exploded, right?
Yep.
And so that's short-term movement, but it does make an interesting case for why is all this short-term movement so sharp, and why, like, if you look at the graph, it looks like Nvidia, Oracle, OpenAI, all these stocks have kind of like peaked recently. And I have a client who has a large sum of money in Nvidia, and she's always asking me, when do we get out? What do we do? Like, it's impossible to know, and it's scary for her. And it's like she's got a massive capital gain built into it because she's held it for a long time. And I bet there's a lot of people out there who have money in Nvidia, individual money in Nvidia, and wondering like, what's coming down the pipe? Is it really like this? We're gonna look back and think like, wow, I can't believe I bought Nvidia at this price or whatever. So yeah. I don't know. It's a little nerve wracking because it does feel a little like a bubble, but it's felt like a bubble for a while now. Does that mean that it's just going to keep feeling like a bubble and it'll work itself out?
Yeah, it's a good question. And to that point, Will, there is some reason to be nervous in regards to, the S&P specifically, just the exposure to tech stocks. They're almost 36%. Mag 7, so Mag 7 accounts for 30% of the weight in the
just
S&P
feels
500.
Like it's not diversified anymore.
Well, yeah, so huge exposure. And so to that point, this is why we highlight this. We are not proponents, and we're trying to do a better job of this in our content and how we talk to clients. Like, we're not proponents of a set it and forget it, sit in the S&P 500 strategy. Like, that is not our philosophy on investing. I think it's been misunderstood sometimes when we talk about like low-cost global diversified portfolio. People assume, for better or for worse, that we're just like, oh, just buy the S&P and sit on it.
Never look at it again.
Yeah, that is not an optimal investment strategy. But let's get Rabih in here and get your thoughts on this. Are we in a bubble, Rabih?
You called it weird, etc. I think I would say there are a couple of companies that are overhyped, but it is not a bubble across the board. Right? This is how I would say it. Like, I would have more confidence in Nvidia and Oracle's stock price just because they are on the stock market. Multiple people can put in their opinion of what the valuation should be. And it is overvalued, yes, just because the market thinks that value is going to be received into the future. If that doesn't happen, the stock price will crash down. As for OpenAI itself, I think that is weird. If OpenAI was a stock on the stock market, I wouldn't be as comfortable in its price as much as I would in Nvidia and Oracle, simply because one, OpenAI is a non-profit legally. It is part of Microsoft, and they just yesterday or before yesterday raised $6.6 billion at a $500 billion valuation. So OpenAI is worth $500 billion. I'm trying to think, you guys remember when Uber did its IPO in 2019? And it IPO'd at a valuation of $80 billion, not 500 billion, 80 billion. And it was unprofitable, just like OpenAI is unprofitable right now. People were losing their minds. Like, this is a zombie company. What
bigger and bigger,
about?
Yeah.
But Uber was able to get out of it. And they are profitable right now. And their stock price trades on the market. OpenAI itself, I have question marks on it. But as an industry as a whole, I don't think so. This is a very revolutionary technology that we're going to have. Actually, if you look at GDP data, and GDP in Q1 dropped 0.5 annualized, in Q2 increased 3.8 annualized. So we had a good GDP growth for the first half of the year. Bowman, the Fed government, was talking earlier this week, and said the economy is divided: consumer, businesses, government, import, export. And the sliver that's related to government, to businesses, there is inventory and there's investment. That investment portion, if you followed me through, half of it, its contribution to GDP, half of that investment contribution was related to investments in AI. So half of the business investments that contributed to the growth of the economy in 2025 came from investments in AI stuff. So it is across the board. It is pushing the economy forward. It really is going to come down to the reality. Will that investment translate to
Future
tangible
value.
changes to our lives? Do I call it a bubble? Not yet. We're just investing across the board. We are taking risk to hopefully change our lives to something better.
The technology is here to stay. It's just a matter of, are these companies going to execute at the price that they're getting valued as growth stocks at this point?
100%.
Because the valuation is not, like Rabih said, based on profit or profitability or money that the actual company's making. They're very much growth stocks at this point.
It's a good point.
On the bright side, it's not based on how many. On the bright side, the valuation is not based on how many people visited the website or how many people still, the same stuff we used to hear during the dot-com bubble or during 2008, etc. So it is stretched, but it is not. Here's the word that they use in the market when it's not a bubble. It's frothy. It's not a bubble, but it's frothy. This is what they use.
Like it.
Yeah, that's a good point. And that's where it might rhyme with history, but it's not the same thing. I think there's a lot of reasons to point out why it's different than .com, when everyone and their dog was setting up a fake company, whatever .com. I remember reading, there's several different books that reference this, but the companies just started putting .com in their name, and their valuation would go up. So it felt, maybe looking back, it seemed more obvious that it's different. Who knows? But it does. Although there are parallels to the level of investment we're seeing and all that, and this could very well end up in a bubble. I like how you're summarizing this, Rabih. That it's probably not a bubble at this point, even if it is a little bit frothy, maybe a little milk mustache. One thing that Mark Zuckerberg said that I think is, just to paraphrase, that I think is interesting, he basically said in an interview recently that he said, the risk is not overinvestment in this technology and these companies, it's actually underinvestment. And it's worth taking the risk of possibly turning this into a mania, because there's a greater risk of not investing enough, which I thought was an interesting take. So I think our conclusion is we're keeping an eye on it. It's not a bubble at this point. We tend to have some pretty good takes on this show, I'd say. Our record is pretty good so far. So any other final words on the bubble, AI bubble, guys? Okay, let's jump in. Last topic here. Will, what the heck is a Trump account?
Trump account. You got to love it. He put his name on the account. It's kind of legendary.
You got to put your name on it. Yeah.
I'm going to start a Will account.
Yeah.
So Trump account was part there. It's been announced for a little while, but I think we should bring it up because I think it's pertinent to everyone and people and clients in general. And it's going to start next year, and children born. So it's a account for kids, Trump account. And it's, again, part of the One Big Beautiful Bill. Parents can open one for any child. Babies born between 2025 and 2028 are going to get a free $1,000 government seed deposit. So you get $1,000 from the government that goes into a Trump account that's you can open for your kid. And there's even talks that they're going to open one automatically for every child that's born between 2025 and 2028. Do you guys know how many babies are born?
I was just going to ask that, and I was going to ask how many kids you're going to have beyond this point.
Yeah, 20 more or so. Yeah, try to guess. What's the number, ballpark, you think?
Oh my gosh, it would just be a total guess.
10
how
million?
many babies are born every year? 1 million. I have no idea.
Higher, lower than what Rabih said. 3.
What did Rabih say?
He said 10.
Oh, 3 million?
3 million babies a year.
Whoa.
On America, we don't even have 10 million?
Yeah.
Yeah, the birth rate's declining. So
yeah.
The math on that, if they do, so again, the talks are that you're not even going to make a choice. Like the account will be open for you, and $1,000 will be placed into it. So 3 million babies at $1,000 a year. What's the math on that?
3 billion.
Yeah. So $3 billion they're going to throw at Trump accounts. per year starting in 2026, but for I think all the babies in 2025, 2026, 2027, 2028. So it's a lot of money, but the kind of the parallel they're drawing to this is, well, there's another interesting data point that they said one of the downsides with this. Do you guys have any idea what percentage of 401k accounts are forgotten?
Oh, I don't remember. We've talked about this before.
So it's 25%.
I was going to say 15. I was about to say 15%.
Which the number that equates to 1.65 trillion in unclaimed assets across the U.S., which is crazy. And it's people that just don't even know that the money's sitting in the accounts, or they've had an employer who's contributed on their behalf. I think there's a risk with the Trump accounts here, where like they're going to put $1,000 into an account, and then it's just going to sit there. And people are, I mean, I can't imagine it's 100% compliance across the board of people that claim that money. But it's an interesting thing. I don't know. Like there's been talks of baby bonds before, and this is like a play for investing in your children's future, teaching them the value of money and investing. And I think it's a pretty solid idea for most people.
Yeah.
But I mean, think of $1,000 that grows over 60 years. It would be a pretty
is this? So if they're setting them up automatically, A, where are they set up? And B, how are they invested?
Yeah. So I don't know the answer to that. And I don't think they've announced that yet.
Got it.
It's still up in the air, but the talks are they want everyone to get it. And so they haven't, it said on the article that I read that assuming you can open them up at any bank or at any brokerage firm or anything, like everyone's going to have a Trump account. And I think clients will be able to open them on behalf of their children. You can fund them with $5,000 a year, and then that you get to skip cap gains essentially if you use it for qualified expenses. So it kind of works like a Roth IRA almost, where you don't pay taxes or capital gains or penalties on any growth if you use it for like a college or first time home purchase or car. There's a big list of qualified expenses for kids.
So if they do set this up and it does automatically go into, let's say, the S&P 500, let's just assume for a moment, that's the government using government funds to place a big buy order every single year, bringing this full circle. I'm just saying, I don't know, but could that be argued that it's something similar? But it's for the kids?
I don't think it's to impact prices, but I think this is the closest the U.S. could ever get to a program related to universal basic income.
Yeah, it's maybe a step towards that.
Yeah.
That's interesting. Yeah, I generally don't. I like the idea overall, like the spirit of it. I think I like the idea. Like I like what it's intended to do.
Like I think we'll probably use them for clients.
Yeah, I would think so. Yeah, why not?
It's essentially like a Roth IRA where the kid doesn't have to be employed, and you know the government's going to give you a free $1,000. You can put it in, it'll grow, and it's better, in my opinion. It may be better than a 529 where you can use it on other things outside of college, but you can also use it for college tax free.
Yeah, let's see this really quick. We're saying $1,000. I'm going to go 18 years. What do we want, Rabih? 7% rate of return?
Yeah.
With nothing. So just $1,000. I put $100. That's not right. $1,000 for 18 years, 7% annually compounded. It ends up being like almost over $3,000. It triples in value. So it's not, but I guess if you let's say you held that, let's just go out a little farther. Let's say you held that till you're 40. Okay, now we're talking $15,000. It's not going to move the needle much.
What about 65?
Till 65, let's give that to you. $81,000. So, but if we're going out farther, we're going to say it's more like a 10%. Let's make it real, or like more historically accurate. So $1,000 for 65 years at a 10% rate of return compounded annually. That's almost $500,000. So, what percentage of those?
If somebody forgets about their money and it gets put in the S&P 500, and then they come back later,
could be $500,000. What percentage of those babies actually wait till they're 65 to touch that money? 0.04%. Yeah. Okay. So more to come on that. Will, we don't know the details yet.
I just think it's interesting. We'll probably honestly open them and use them for clients. Why not? And it's going to be now in the conversation of brokerage account, 529, Roth IRA. We have these conversations with clients all the time around what kind of savings account should I open for my kids? This is going to be one of them.
Yeah. Yeah. Interesting. Yeah. And like you said, why not? Because the money's coming anyway. So you might as well take it for your kid and Okay, so I think Rabih, is this the final straw for you to have kids? I think this might be it. Trump and I have banded
No.
together to get you to have
Absolutely
kids.
not.
No?
Absolutely not.
Okay, Trump and I are going to keep working on you. We're going to keep working. What amount of money would he have to increase that to for you to do it? Would it have to? Well, let's play that game. What amount of money would the Trump account have to be for you to finally be like, all right, I'll do it?
Enough money where if I have to have kids, the U.S. economy will crash.
Yeah.
And then there's no pressure on me to having kids.
Okay, perfect. Okay, that's good to know. That's good to know. Okay, any other final words of wisdom for the people? No? Okay. I should have announced this to start. I was too busy speaking Chinese. But we have rolled out a new program, the Dentist Money Launchpad, or I should say we are rolling it out. And we have tons of exciting things happening with it. It's going to be rolling out next year, so early 2026. It's going to be a live 12-week program. We're going to be talking about everything from controlling your cash flow and debt, investing with confidence, navigating your career, how to negotiate contracts, and then just designing your investment plan, financial plan. This is specifically for D4s and new grads. So it's Dentist Money Launchpad. What I'm the most excited about is the group of teachers we're kind of putting together, or mentors we're putting together for this program. So you've got, of course, Rabih Damachki is going to be on there speaking about investing. We've got, obviously, Will's going to be involved in this. I talked to Daniel Crosby this morning about this exact program. I sent him the link to it, and he's super excited. So Daniel Crosby is going to be doing this. Carl Richards, our very own Christine Ewan. We've got Tony Schicktans, who's going to be doing one of the classes. So we're kind of putting together a great group to hopefully bring a ton of value to new grads in the dental space and launch you off into your financial life and set the foundation for you. So if you have any interest in this, we encourage you to go to dentistadvisors.com/launchpad. There is a yellow button there. You can click to join the waiting list. You'll be part of our first cohort, which will be getting a significant discount to be part of that first group on the program. And if you have any questions, let us know. And then, of course, if you want to talk to us, you can go to, again, dentistadvisors.com, book a free consultation. We'd love to hear from you and talk to you. For now, thank you so much for listening. Will, Rabih, thanks for sharing your wisdom. Until next time, that was our 2 cents. Have a good weekend. Bye-bye.